I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to the burning issues in private markets. Public markets keep shrinking, pushing funds to focus more on private lending. Then settling down in luxury property markets with global cities looking toward a brighter 2020. And getting richer, Bill Gates, Mark Zuckerberg, and other global billionaires adding more than $1 trillion to their wealth this year. Well, let's get straight into these burning issues. With me, Bloomberg's Jason Kelly, Sonali Basak, and Patrick Clark. Let's start with Jason in San Francisco. The public markets have been shrinking. Can you just give us a sense of how much we have seen the public world contract?
Well, it's dramatic here, Lisa, and obviously I'm right here in the heart of it in San Francisco, where companies stay private for longer. And what that has meant is that essentially over the last 2 decades, about half of the public companies have gone away. They're not publicly traded anymore. And that has been a boon, obviously, here, companies staying private for longer, but it has real life implications for lots of investors.
All right, so can we get a sense of why so many companies are deciding against going public, why they're sticking with private financing?
Well, mainly because the money is absolutely available. You know, here in Silicon Valley, we talk a lot about venture capital, obviously, but private equity, we're talking about $4+ trillion of assets under management when you think about private equity writ large, including venture capital. So the money's there. The likes of Uber and Lyft and all the companies, you know, all these unicorns that sort of roam around this part of the country, they can get money. They don't need to go public.
Jason, you make a really interesting picture of San Francisco with all these unicorns just wandering around looking for financing. But I'm wondering,
they're everywhere. You can ride them.
You can ride unicorns. I'll look for that picture of you riding unicorns. I am curious, though, do we ever see this trend changing and companies deciding to go back to IPOing and going to public markets?
Well, certainly those of us who were around for the dot-com bust back in 2000 remember that the money did dry up a little bit, and you know, things can change for sure. But it does feel like, and you cover this on your show all the time, you and I talk about it a lot on the desk, the money has shifted, the market has shifted. It feels more secular than cyclical, as they say. Private markets certainly here to stay. The question is, can investors get the type of liquidity that they need to really trade in and out of these names in the way that they can on the public market?
All right, Jason, have so much fun riding those unicorns. It does bring us to the companies that do decide to go public. And Sonali, there are companies still hoping to rely on IPOs next year for financing. What are some of those names?
So some of the biggest companies that we're looking forward to is Airbnb, which has been pretty vocal about their hopes of going public, and they do tend to turn a profit. So we'll watch for how they do it.
Which is rare.
Yes.
Among some of them.
Exactly.
But carry on, yes.
It is not definitely something that's unanimous among unicorn worlds. So Airbnb is one of the hopefuls for 2020. And then we also have DoorDash, which is not profitable, SoftBank backed. It's going to be a really interesting ride. There's a lot of skepticism baked into the DoorDash story also.
Given how much money there is in private markets, why are they going public?
Well, people still like to have liquidity for their employees as well as their existing investors.
Employees like the founders, for example?
Right, and the hope here is exactly the founders especially, but also the other employees. And there is a hope that going public will help you grow faster, give you a more diversified base of shareholders, give you a longer lifeline. Remember, look at the top 4 big tech companies. Look at the FANGs. It still gives you a rite of passage into kind of being a grown-up company. And so those with the hope of longevity would still like to use the path.
All right, so there are going to be some IPOs. Meanwhile, let's turn to luxury real estate, which has been a rough spot this year around the world, sort of. I mean, slightly rough. Some people are growing a little bit more optimistic, though, next year. Patrick, can you give a sense, first of all, when I came in, I said to you, so how bad has it been? And you're like, it's fine.
It's not that bad for me.
Oh, well, but it's how big have the declines been in some of these property markets?
Well, you know, it goes market by market. You definitely do have cities like New York, you have Manhattan, where there has been large influx of new supply, and so there's too many high-end apartments on the market. So sellers haven't been able to get the prices that they've wanted. You've had taxes and other government efforts in places like London or Vancouver to sort of cool off markets, to make it harder or more expensive for foreign buyers, and all of that has had a toll this year.
All right, a toll, although you seem like you're playing the smallest violin that I could ever see. What about next year? What are we expecting?
I think the pendulum is going to swing back a little bit, at least, again, in certain places, particularly where there's been less new inventory coming onto the market. Places where maybe, you could look at London where the political situation looks a little more clear. Maybe people have more confidence in investing in real estate there. You have cities like Miami where, the U.S. tax policy is kind of pushing wealthy home buyers to take up residence in Florida where they don't have to pay income tax, and so that could be a boon. Again, that's a market where the supply-demand sort of balance is a little bit better for sellers.
All right, Patrick, Shonali, Jason, thank you all so much for that update. It brings us to Real Estate Roundup. I recently discussed the New York City luxury market with Bess Friedman, Chief Executive Officer of the real estate firm Brown Harris Stevens, as we reviewed the year in New York City real estate. Take a listen.
It was a challenging market for sure. It's been a little bit slow. We had a little bit of a push in the second quarter because people were trying to close before the mansion tax hit in July. So that was good, but it was a slow year, steady. We probably are very similar to 2018 as far as numbers go. So it's been a slow sort of decline. The market has kind of been doing this, and we're in a correction environment.
So how much are they going down?
They have slowly been adjusting. I would say roughly it's been about 10%, give or take, but it depends. If you've been an overpriced co-op on the Upper East Side by 30%, then you obviously need to come down 30%. Some sellers have been totally off the mark, and some sellers are more realistic. They realize that the market is in a different place. It's no longer a seller's market. It is completely a buyer's market. And if they want to sell, they have to be realistic, or their apartment is going to linger, or their home, townhouse, whatever it is.
Are we starting to see a bottoming out, or is the pain going to continue through 2020?
I think we're starting to see a little bit of a bottoming out, but the issue that I see for 2020 is that we're in oversupply mode in New York City. We have a lot of supply, and so when supply is here and demand is here, if they don't intersect, it's slow. And so right now we have a lot of product to sell, and buyers are taking their time because they can pick and choose.
The supply, though, is not throughout the entire market. What price point are the extra apartments?
That's really hard to say, but I can tell you for resales, resale listings, not new development, we'll separate that. Roughly the listings that we have are valued at, in the marketplace of New York City, $19 billion of resale listings versus 2014, we had $14 billion worth of resale listings in the marketplace. That's just all together. That could be one bedrooms, that can be, so it's a mix, but that just shows you that there's a lot of product. We've had an increase of roughly 30%. So buyers now, there's so much to choose from.
How much is New York City emblematic of a weakening more broadly throughout the country when it comes to property? And how much is this a very specific issue having to do with overbuilding and having to do with the SALT tax and some other issues?
I think it's really more specific to New York City because other areas, if you look around the country, are pretty healthy. There's actually not a lot of supply, and the market is pretty healthy. The economy is good and all those things. The numbers look good. Rates are great. But New York is specific. The SALT, the cap on that deduction really impacted us. People moved out. They went to Florida. And now we have all this looming, legislation in Albany that's really going to hurt our market. So that concerns me.
All right. You were talking in particular before about one legislative provision. Can you talk a little bit about that?
Yeah, there is a pending pied-à-terre tax. And a pied-à-terre tax, which what a pied-à-terre is, and I'm sure everybody knows this, is someone who lives in New York City part-time. This is their second home, their third home. And we have a lot of people who have homes here but don't live here full-time, right? They don't pay income tax, but they pay all the other taxes because they don't live here. This pied-à-terre tax would tax them annually at an incredible rate, and I don't have the exact numbers, but it would be very egregious, and it would deter people from buying here and owning second and third homes. Now, we did a little bit of study of this and looked into it, and roughly there's $1 billion annually generated from pied-à-terre homeowners in New York City. That being said, that means millions of dollars in taxes for the city. That means thousands of jobs for the city.
So understood that the real estate and the developers and just brokers in general are anti, right? And homeowners as well. They're against this.
Yeah.
Okay, on the flip side,
yes,
when you talk about what this would do to property valuations, if this legislation does go through, are there any estimates of how much it would reduce valuations of apartment buildings or commercial real estate in the city?
We don't have any estimates of that, but back to the actual pied-à-terre tax is that they think it would generate something like $650 million. We think much less, like 250 to 300.
What about in Miami? I know you also focus on Miami. What are you seeing there?
You know, Miami has been a pretty decent market because a lot of people have left New York, unfortunately, and moved to Palm Beach, moved to Miami. They find Florida to be this sort of safe haven. So people don't want to be in New York because they want to, avoid the taxes. And I understand that.
I think about people buying these, beautiful houses right on the beach in Miami. And I'm wondering, how concerned are they about the fact that we occasionally get hurricanes and things like that that wipe out the entire property?
I think there's definitely people who are concerned about it. I mean, I would have some trepidation about that. But, people, you only live once. They want to have these homes. Who knows what's going to happen?
That was Bess Friedman, Chief Executive Officer of the real estate firm Brown Harris Stevens. Coming up, 2019 was a big year for us as we launched this show. Next, we revisit one of my favorite interviews of the year, Howard Marks from Oaktree Capital. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Play, our look at some of the most notable names in private markets. And we turn back the calendar to the very first edition of this show when I spoke with Oaktree Capital's Howard Marks. Recently, distressed debt supply increased to a new cycle high of $127 billion, a level last seen in 2016, but supply stagnated for most of the first half of the year. And that is when I sat down with Marks and asked him how he was investing in that climate.
I don't think we're in a bubble. I don't think we're going into a bubble comparable to 08. So there's no reason to believe that we'll have the panic that we had in the fourth quarter of 08 following the bankruptcy of Lehman Brothers, another global financial crisis. But, there's been a great deal of debt issued. There's been a battle to be the person who buys that debt. The battle has taken the form of bidding down the quality and the safety. So there's a lot of risky, aggressive debt that's been issued in the last 5+ years. And when that collides with a weak economy, I think there'll be great opportunities.
So right now, there's a record amount of dry powder or just cash, I guess, or that's been committed to some of these mandates. And I'm wondering where you're seeing opportunities, even though everything has been bid up at this point.
Opportunities are very few today. I wouldn't even use the term seeing opportunities. Investing in distressed debt is a struggle today. The economy is too good. The capital markets are too generous. It's hard for a company to get into trouble. If they get into trouble, the capital markets are happy to bail them out. It's a struggle today, and it would be misleading to your viewers to talk about where there are opportunities. They're practically non-existent.
Well, does that mean that you're not investing?
Largely, yes. It's very, very hard to put money to work in distressed debt.
Would you rather than put your money in cash, or where do you put it instead?
Well, what we do is we don't call it. We form funds, people commit amounts of money to the funds, and we call it as we spend it. So right now, we're not calling very much.
What about China? You've talked about how there are opportunities there. Is that still the case?
That's the big question. They have troubled companies. They have a future. The loans, if you can buy them at the right price, should be worth more sometime down the road. Will you get it? Will they apply the rule of law? One of the reasons that our investing has been successful in this country over the last 31 years, Bruce Karsh is a lawyer, understands this process, and knows how to project the outcome based on the rule of law. Will it apply in China? We believe so. We're taking baby steps to explore whether it does.
You said baby steps. Does that mean that you're not necessarily actually deploying cash there yet?
No, we're deploying baby cash.
Baby cash. What's baby cash for Oaktree? I have to wonder.
A few
billion here and there.
You put a toe in, you put a foot in, you put a, that kind of thing.
Yeah.
We've been doing it for 4 years. We've been stepping up the amounts, and we're testing the waters.
Going back to sort of the overall distressed debt market and how it's become more mainstream.
Yes.
There have been a number of giants in the field that have taken a step back in a big way or exited the field for new opportunities. Do you view that as a market peak?
Well, even if you look at us, we're not doing much in distressed debt right now. We're active in a lot of other fields. And, one thing you have to understand distressed debt, you have to understand that we cannot create our own deal flow. If you're in private equity, you can create your own deal flow. You can go to any company in the country, public or private, and say, we'd like to buy you. Distressed debt doesn't create its own deal flow. If there is no distress, we can't make distress. And so we have to turn to other activities. And Oaktree is active in lots of other fields.
What are some of the areas that are sort of pulling you toward them rather than distress?
Well, we're doing private lending, mezzanine lending. We're investing in real estate and real estate lending. We're investing in infrastructure and the power industry, and high yield bonds, leveraged loans.
That was my conversation with Howard Marks from Oaktree Capital. Now, distressed debt has had an inconsistent year this year. The lowest rated junk bonds have underperformed higher rated ones through much of the year, but a lot of these bonds have actually been rallying this month. And this year really has been one of discretion, which is giving a lot of managers confidence that debt markets aren't scarily frothy heading into next year. Coming up, we're going to be taking a look at Jeff Bezos and how he was one of just 52 people on the Bloomberg Billionaires Index that saw their fortunes decline on the year. Next, we dig into the winners and decliners of 2019. This is Bloomberg Money Undercover. Time now for pension pressure. Arizona's $41 billion state retirement system is making a big bet on private credit, putting 1 out of every $6 it manages to direct lending. That's more than 5 times the industry average. Here with more is Bloomberg's Kelsey Butler. And can you give us a sense, Kelsey, putting into perspective this shift by Arizona?
Yeah, so it's definitely, as you mentioned, high above what some of its peers are doing. Right now, they have about 13% in direct lending. They're looking to boost that to 17% over the next few years. Just to put that in perspective, another pension fund recently decided to shift away from junk bonds to private credit, and their target allocation is 5%. So we're talking about a much bigger bet than others are making.
But there has been a large shift among pensions toward the private lending area. Can you give us a sense of how big it's been?
Yeah, so it's definitely grown over time. Right now, there are nearly 300 pension funds in the U.S. that are active in private credit. That's up from about 180 in 2015 alone, and they're boosting their allocations as they go as well.
So can you give us a sense of what the goal here is? Is it just bigger returns?
Yes, that's basically what it all boils down to in this low-rate world that we're living in. They're really looking to make sure that they're meeting their return benchmarks. And the research has shown that by investing in direct lending, investors can get up to 5 percentage points above what they would get in other more liquid parts of credit. So pension funds are taking note, and they are pouring into private debt.
Is there any concern that the future returns are not going to be like the past returns, given how much money has been coming into the area?
Well, that's definitely a concern, especially since a lot of these new managers haven't really gone through multiple cycles. There's always, of course, the concern about deteriorating credit quality, but a lot of these pension funds feel that they've picked the right managers, that they have made the right decisions about where they've put their money, and they're comfortable with where they are.
Kelsey Butler, thank you so much for that. Now for this week's Billionaire Beat. The rich got even richer this year. According to the Bloomberg Billionaires Index, the world's 500 wealthiest people added more than $1 trillion to their fortunes, boosting their collective net worth by 25% to almost $6 trillion. For more, we welcome Bloomberg's Ben Steverman. So can you give us a sense of just who did really well, who did less well? Give us the rundown.
Well, basically all of them did well, more or less. Like 90% of these billionaires that we track, the 500 richest people in the world, 90% of them did well, like really well this year as markets went up and business values went up. One exception is Jeff Bezos, but that's entirely because he got divorced during the year, and his wife is now the fifth richest woman in the world.
So is this just a matter of billionaires having their money in the markets rallied, so they added to their net worth, or does this go beyond that?
Yeah, I mean, I think that's basically it. I mean, once you have that much wealth, it's in these businesses that are trading and been doing really well asset values have just exploded since the Great Recession, and we've seen this sort of continuing trend, and it's not ending.
So Mark Zuckerberg adding $26 billion to his wealth, Warren Buffett $5 billion. I have to wonder, as we head into 2020, an election year, how this plays politically.
Yeah, it's really a big question. Like, this is the year that Elizabeth Warren introduced her wealth tax, and it was surprisingly popular, and it still is surprisingly popular in polls. I don't know what that bodes. Another thing that happened this year, though, is Jeremy Corbyn ran on sort of a soak the rich strategy, and he really lost the UK election.
But there is a question how much to get ahead of it with some of these billionaires engaging in philanthropy. How much are we seeing that?
Yeah, this has also been a year where we've had a lot more scrutiny of philanthropy, actually. Like, the thing is that people like Bill Gates and Warren Buffett have been incredibly generous, but they're not giving their money away fast enough. So they're wealthier than they've ever been. So to what extent is this philanthropy really papering over society's problems, or how much of it is just PR, and how much is it really making a difference? And so there's been a lot of conversation about that.
Well, thank you so much for being with us, Ben Steverman. Really interesting story. And speaking of big money, it is time for this week's big number. It's $13.5 billion. That is the amount raised by special purpose acquisition companies this year. That is the most on record, surpassing 2007's $11.7 billion total. These vehicles have become a popular choice for private companies spooked by the swings in the regular IPO market, as we were talking about earlier with Jason Kelly and Shonali Basak. That does it for us. Happy New Year to everyone. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 2 a.m. in Hong Kong. From New York, this is Bloomberg.